Hi, I'm David Waddell. I am President, CEO, and Chief Investment Strategist of Waddell & Associates, and this is our 2018 State of the Union Address. As I was preparing for this presentation, it occurred to me that it's been nearly a decade since the great financial crisis. A decade of basically benign inflation, growing economics, and robust investor returns. Now, the decade hadn't passed without some panic attacks. Remember the flash crash, remember the Chinese devaluation, remember the Greek debt default, the US downgrade, and even, finally, Brexit. So it's been an interesting decade, but over that time, global corporations have innovated and they've prospered. In fact, this is the second longest economic advance in history and the second strongest bull market in history. But how long can it last? And what will the end look like? Those were the questions that I endeavored to answer in preparation for the material you are about to see. But before we look forward, let's take a look back. This time last year, I stood before you and said that the U.S. voter might be a little disappointed with the amount of economic growth generated by just the U.S. Federal Reserve, who had pursued a zero interest rate policy, quantitative easing, and then finally dollar depreciation. And so on November 8th of 2016, they hit the ballot box and voted for regulatory cuts, tax cuts, foreign capital repatriation, defense spending, and even more infrastructure spending. And we saw the combination of this significant monetary stimulus and fiscal stimulus as potentially taking the U.S. economy into a higher gear. And so our theme for 2017 was that we would be shifting gears. We thought that monetary stimulus would likely be replaced, if not added to, by fiscal stimulus, and that, of course, happened. We thought that globalization would possibly morph into a new brand of nationalism, which occurred. We thought that the economic redistribution policies in Washington might defer to economic acceleration policies, which, of course, occurred. We thought that all the concerns around disinflation would be replaced by concerns around inflation. We thought that falling yields would transition into rising yields, which occurred. And then we thought the dollar weakness might, in an American first sort of presidency, transition into dollar strength. That did not occur, which is a little confounding, and we'll talk a little bit more about that later. And then we thought that investors might change their appetites from chasing safety and yield to chasing risk and capital appreciation. That definitely occurred. And so we thought we might transition the national conversation, the zeitgeist, if you will, from sharing to winning. And in 2017, nearly everyone was a winner. And let's see what winning looked like. Winning looks like global economic growth accelerates. Here's a chart taking you back to 2011 and answering the question, what speed was the global economy growing at? And you can see in 2011 we were growing about 4%, and then there's this steady downturn all the way into 2016. Well, we turned a corner in 2017 with growth vaulting from about 3% to 3.7%. And that strong economic momentum was enjoyed by nearly every nation on the planet. So in the analysis I did, there are about 195 countries that report economic estimates and results, and 189 of them posted gains last year for maybe the broadest-based economic advance in history. And that kind of participation certainly motivated and cheered investors. So here is a chart showing you global investment returns by country in 2017. Obviously, if you had all of your money in Austria, you enjoyed 52% returns last year, but it was Egypt, it was Japan, it was Singapore, it was everybody. In fact, I struggled to find any negative returns on the planet, but I found them. Qatar and Pakistan did not perform well last year. If you have those as heavyweights in your portfolio, please give us a call. The other way to look at the massive rally we saw on the planet last year is to ask, how did the currency market perform? Well, if you take currency out of the equation, you can see that the US markets appreciated about 21%. All of the other countries combined outside the US went up about 18% in their local currency. But as I said before, the US dollar actually weakened. And when the dollar weakens, that means other currencies strengthened. And the strengthening of those other currencies tacked on about another 9% to the international investment returns, making the international markets more profitable last year than the U.S. markets for the first time in a long time. So winning also looks like currencies rally across the planet. Here in the U.S., 2017 will be remembered as one of the best years ever for investors from a risk-return perspective. Here's a chart going back 30 years that notes every year and equates return to volatility. For orientation, in the top left side of your chart, you should see 1995. That was a fantastic year for returns, also a very low standard deviation year. And in the bottom right, you should see 2008, which obviously was a terrible year for returns and also a year of very high volatility. So what did we see from 2017? Pretty amazing. In fact, 2017 had 0 months with negative returns in the S&P, 0 days with less than 2% drawdowns or more than 2% drawdowns, 0 days with the VIX above the historic average, and the VIX, which is the volatility index, actually hit all-time lows. So for U.S. investors, it doesn't really get much better than that. Within the U.S. market, however, there were some winners and then some who won even more. So if we look at the value indices in 2017, we can see that they got 10 to 15% overall rates of return, which was very good, but they lagged substantially the growth indices within the U.S. market, which hold a heavy slug of technology. In 2017 resembled a little bit of a throwback to 1999. The tech indices were up about 40% last year, and given the larger allocation in the growth indices, we can see small cap, mid cap growth doing very well. And then finally, again, making it look like 1999, large cap growth went up 25%. Now, every good bull market has to have an acronym. And so FANG ended up being the acronym of choice for the 2017 market. For those of you unfamiliar, that's the combination of Facebook, Amazon, Netflix, and Google, which on average went up 50% last year. Now, they account for 10% of the weighting in the S&P 500, meaning that alone they contributed 25% of the gains overall in the S&P. What I find interesting about this is the last time we saw tech companies performing to this degree was back in 1999, and their returns were predicated upon the hope for what the internet companies could do in the future. And then the FANG rally of 2017, it was predicated upon what these companies really have become, global dominant franchises. Pretty amazing. Winning also looks like bondholders made money. So if you had U.S. Treasury bonds last year, you basically clipped your coupons, made a little over 2%. If you held corporate bonds, you got the yield. You also got some capital appreciation given the strength in the economy. Overall, bonds returned about 3.5%. So even bondholders made money last year. And you know that winning is afoot when after 52 years, my treasured Philadelphia Eagles actually took home the Lombardi Trophy. Clearly that is what winning looks like. So what about 2018? Well, why don't we just win some more? Never before in the history of the United States have we received this much stimulus at the end of an economic cycle. So right before the holidays, President Trump signed an order to bring the statutory corporate tax rate down from 35% to 21%. That's a 40% cut in the overall rate, which is astounding. And what it immediately caused was an upgrade in the profitability estimates across all of the companies within the S&P 500 shown here. So in our bottom line, what you're seeing is a chronicling of analyst estimates for 2018 earnings. And you can see right after the tax plan was passed, an 8% hockey stick-like move higher in earnings expectations. And that has happened in 2019's numbers as well, with a 9% boost from there. So we had robust growth to begin with, and we just turbocharged that with the tax cuts. So what are companies going to do with all of this newfound fortune? Well, Evercore ISI went back and asked companies specifically that question, and what they found was 23% of the respondents said they were going to reinvest and they were going to engage in capital expenditures, property, plant, and equipment to boost their businesses. 17% said they'd pay down debt, 10% said they'd increase employee compensation. 7% said we'd use that money to do mergers and acquisitions. 4% said they'll increase pension funding, another way to pay the employees. And then finally, the bottom 3% said, you know what, we'll cut prices, or if we're utilities, we'll cut rates to stimulate sales. So let's look at those now that we have some data. This may be the most important slide in the presentation. This shows what business leaders plan to spend on capital expenditures going forward. And what you can see is that we were in this trend lower going into the end of 2016. It means that companies had very little confidence in the future for their business and for the economy. As soon as the Trump wave swept through Washington, what you saw was companies get more confident, thinking that there'd be deregulation and potentially tax cuts. And then you can see going into the end of 2017, a leg higher when those tax cuts became law. The reason this is so important is because there are really only two things that grow an economy. One is the amount of employees in the workforce working, and two is how productive they are. We have a bit of a demographic problem, which we addressed at this time last year. Birth rates are low. We also have some immigration issues with legislation that doesn't seem to find finality. And so we're a little challenged demographically. Therefore, the pathway forward for economic growth is to boost productivity. Well, the way you boost productivity is through investment. Without investment, you don't get productivity. This is what the tax cut was all about. And already what we've seen is an uptick in equipment purchases, capital expenditures, and all of that forecasts a strengthening economy going forward. But it wasn't just an opportunity to boost capital expenditures. It was also the opportunity to try and get some wage growth back into the hands of the employees. So as of today, this data is a little old, there are 411 companies that have given pay raises, bonuses, increased 401k contributions for about 4 million Americans plus. And I just picked a sampling of companies here, but you can see it's large companies like Apple, and it's small companies that I've never heard of, like Affinson Farm Store. I do not know these people, but they're happy, and they should be, because a lot of people are seeing wage gains. So what do people do when they're happy like that and they've got a pocket full of cash? They spend it. The Consumer Confidence Index going back to 1990 hasn't been this high since the dot-com era. And what do people do when they feel confident? They buy stuff, which is important because consumers account for 70% of the US economy. So when you combine what's going on with investment activity and what's sure to happen with consumption activity, there's an opportunity to upgrade the growth trajectory of the economy overall. And so economists predict that in 2018, the tax cuts will add anywhere from 1/4 to 0.5% to what was already reasonable GDP growth. That could put us over the 3% line, which we haven't been over since 2005. So the upgrade to the US economy precipitates an upgrade to the world economy. These squiggle lines, as they're called, are drawn by economists at the IMF who ask themselves the question, how fast will the economy grow in the future? Well, you can see over time that economists at the IMF had been downgrading their annual expectations. I'll pick on 2015. They thought originally that 2015 would grow at 4%, and ultimately it grew at 3%, and you can see the same held true for 2016. But then something changed in 2017, and even further in 2018. So for the first time in a long time, economists are actually upgrading their growth expectations for the global economy. And how do investors feel about that? Well, they haven't felt as good about the market as they do today since 1986. This is a jubilant floor trader I do not know, but if you do the math, basically professional investors are 5 times more bullish than they are bearish. The last time they were this optimistic, 1986, which was last year we had tax reform. Now, all of this optimism does already price into the market, unfortunately, in terms of higher valuations. And this is the PE ratio going back to 1985. Now, you can see that we're at an elevated level, which leads lots of strategists to say you should expect that PE ratio to fall from here. However, if you look at history, what you find is although PE ratios tend to accelerate a lot in the beginning of a cycle, tend to flatline in the middle of a cycle. In the last year of a bull market, they actually tend to go higher still, and then obviously you get your comeuppance once recession hits. So now let's do some simple math. All right, if the earnings forecast for 2018 is $156 a share across the S&P, and currently today we're trading at 27.30, then that means our PE is 17.5. Going forward, our 2019 earnings forecast is for 174. So if the PE stays the same, then you should anticipate an 11 to 12% gain from the stock market from here. However, if history proves true and we actually see a click higher in the PE, then you could see a market as high as 3,300, which would simply take the earnings growth forecasted for 2019 and then add to that the expansion in multiple of 1.5. That would be 22% higher. Now that would be awesome, but at that point the market would likely need a breather. So just to think about that a little bit further, this is our old trusty stock market psychology cycle. And this is actually a composite of previous market returns, and you can see that markets come out of a period like they did in 2009 and they rally robustly. That's usually institutional type money, and then they trend sideways, and then ultimately some event happens where they break out of a consolidation phase and they extend into the later part of the cycle where people start feeling more optimistic. Well, we told you last year that we thought maybe, given the fiscal stimulus that the Trump agenda would add, that we've broken out of that cautionary phase. Mid-year, we actually thought we'd entered the enthusiasm phase, and now at this point, we figure we're kind of late in the enthusiasm phase. Now, that doesn't mean things are over, but they're getting closer to the end. And there are some bubbles blowing. There may be some room left in the stock market, but there are other areas of the economy looking a little frothy. One of those areas is venture capital. We have not seen this much venture capital go into new businesses since 1999. That is a stuffed unicorn. There are many unicorns flying about: Airbnb, Dropbox, Uber, companies with billion dollar valuations. And that's just emblematic, I think, of the excesses that currently exist in the venture capital field right now. On the private equity side, really it's even more robust. Right now we see $1 trillion in dry powder sitting within private equity funds. Now what that means is if you got a small business, a mid-sized business, you've got a piece of property, now's a good time to sell because there's more cash than ever before sitting on the sidelines, and the investment bankers only get paid if that cash gets put to work. Multiples are at record high, and that is a function of record high funding levels across private equity. Also, every good bull market has a mascot, so the legalization in many areas of marijuana has led to a good amount of investor enthusiasm. I'm showing some Canadian stocks here that got particularly high last year. You can see Canopy, Aria, Afria, companies I'm not really all that familiar with, but obviously they caught the excitement of investor imagination. These are specifically listed on Canadian exchanges where there are lots of good hot stocks getting high. And lastly, there's the mother of all bubbles, Bitcoin. Now, to put Bitcoin and the size of this bubble in perspective, we have to go all the way back to the Netherlands in the 1600s. At that time, the Dutch economy was larger than, really, it was the most prosperous economy on the planet. And the rich within the Netherlands at that time viewed tulips as the ultimate expression of their good fortune. And as soon as the financiers figured this out, they created futures contracts on exotic varietals of tulips. They securitized them, they turned them into trading vehicles, and once they did that, the demand and the ability to transact took tulip prices up almost 40 times their initial value within a 3-year period. Now, there have been other bubbles. There was the South Sea bubbles in the 1700s, the Mississippi Company, but nothing as dramatic as what happened to tulips until Bitcoin came along. Bitcoin over the last 3 years has actually risen by a multiple of 60 times its initial offering price relative to 40 times with tulips. Now, is Bitcoin the currency of the future, or will this end up being just another foolish footnote in history? I'm not sure, but for my money, I'd rather have a tulip. Now, given the fact that we've had almost a decade of pretty solid market returns and economic growth, and that we've got some investor optimism peaking, and we see trends and bubble tendencies in things like cryptocurrencies, perhaps now is the time for caution. If that's the case, what will the end truly look like? Okay, I think there are going to be 4 stages to the end of this long economic advance and this long bull market. The first stage is that we'll see rising inflation expectations. Inflation's been interesting since the Great Recession. It's been baffling economists at its low level for this entire time period. Remember, coming out of the Great Recession, the Fed printed money and we were all worried that it was going to flood the system with inflation, and the gold bug sold gold on every corner. Well, that hasn't really been the case, and here's, I think, why. So this separates out the services sides of the economy from the goods side of the economy. And what you can see, the Fed's target inflation rate is 2%. And on the services side, we've been running decidedly above that at 2.5% for almost the entire cycle. However, on the goods side, you can see that prices have actually been falling throughout the cycle. Any idea why? I call it Amazonification. The margin-busting imperialist tendencies of Amazon and their copycats have basically taken prices down across the board on a number of consumer goods, anywhere from books to now flank steaks. And so that has really suppressed consumer inflation, which again is a large portion of the inflationary picture. And so this chart goes back and says, all right, well, what's inflation been for the cycle overall? You can see the 2% demarcation line is what the Fed is hoping to keep inflation beneath, or at least equivalent to. And over the entire cycle, inflation's remained beneath. But yet we see the increase in the Fed funds rate nonetheless. Why is that? Because the Fed does not raise interest rates based upon inflation today. It raises interest rates based upon inflation tomorrow. So this is a curve that says 5 years from now, what's the 5-year forward inflation expectation look like? And you can see that that's been rising ever since the Brexit vote, which is why the Fed has been increasing interest rates. So the question you must ask now is, at which point do the interest rate increases start to drag upon the economy? Well, that's stage 2, where central bank policy becomes a drag. We're calling it contractionary central bank policy for fun. All right, the Fed has told us what they expect to do. And so we sit today at 1.5% basically on the overnight rate. And they said, we'll probably raise rates 3 times in 2018, twice in 2019, and then maybe one more for good measure in 2020. And so that puts the ultimate destination at about 3%. But is that the right amount of hikes? Is that the right speed? Well, economists do have a way of sort of gauging that. This line here is an economic construct, but it's the real natural rate of interest. And it basically hypothesizes what's the rate of interest that would cause neither inflation nor crimp growth. It would basically be inflation and growth at equilibrium. Yes, it's theoretical, but it gives us a target. Once we layer on top of that the Fed funds rate over time, what you can see is there are certain periods of time when the Fed funds rate is higher than the natural rate, and certain periods of time when it's lower than the natural rate. When it's higher than the natural rate, those times can be described as too tight. Policy's too tight and invites in, ultimately, economic drawdown or recession. And then there are times when policy is too loose. After a recession, the Fed will cut rates and loosen monetary policy to try and stimulate the economy, and that works great until it stokes the inflationary spirits once again, and then they have to tighten up, which is the process that we're in right now. Here's another way of framing that chart. The 0 line is the demarcation line between too tight and too loose. Obviously, if it's above the line, it's too tight. If it's below the line, it's too loose. Right now, we're a little bit below the line, which means we still have accommodative monetary policy. However, going forward, you can see the Fed expecting to raise interest rates up to what I call the cautionary zone, which is when the real Fed funds rate is about 1% above the natural rate of interest. And they're forecasting to have us there sometime between now and probably 2020. All right. So once they over-tighten, what we'll see is a reduction in at least trajectory on a variety of pre-recession sort of indicators. So this chart's supposed to look confusing, but I am just taking apart, if you will, the leading economic index into its components. And so you see building permits are rising, jobless claims are falling. You see the S&P 500, which is the stock market, going up, and no real decline in credit spreads. So all of those things that are forward-looking get aggregated into one index, and here it is. And what you can see is this index has a very good history of predicting recession anywhere from 2 months to 15 months ahead of time. Just to calm your fears, right now this index is actually at 2.9%, up from the 2.6% I highlighted here when I put the slide together. So we are nowhere near a recession at this point, and we'll have fair warning once these pre-recession indicators roll over. All right, then you get to stage 4, which, yes, a dirty word in our profession, recession. Now, the important thing to understand about recessions is that they're just a natural part of life. They are the forest fire, and out of that comes new growth, and never in the history of the U.S. have we gone into recession and not recaptured new highs in the stock market after. So this is going to happen. Let's go ahead and prepare for it. All right. This is a chart that shows the drawdown in the stock market going back all the way to 1950. And in normal years, the stock market goes down around 15% in a normal contraction, and that happens sort of every 10 to 15 months. But in recessionary periods, we see much larger drawdowns of anywhere near 30%, depending on the severity of the recession. So these are painful periods. Question is there something we should be doing about it? Well, I think there is. We have shared with you our view that probably we're within 24 months or so, depending upon the Fed's tightening cycle, of triggering a recession, and there are other analytical frameworks that validate our math. So this is a chart that KKR put together using one of their tools going back to about 1999, and they basically correctly predicted the recession in 2001 and the subsequent recession in 2008. And right now, it's at the highest level it's been at since 2005. So if a recession is in the works, at least within the next 24 months or so, should you sell? The answer is yes, but not yet. This chart is a composite of investment returns for the stock market going back 24 months into a recession. And what you can see is between 24 months and 12 months leading up to a recession, stocks have gained anywhere from 15 to 25% on average, which is pretty sizable and worth sticking around for. After that, a year out from recession, what you can see is they tend to flatline and then begin their decline. So the answer is, if you knew a recession was 24 months out, you should sell, but probably not for another 12 or 18 months. And so with that, we can put together what I call our late cycle playbook. Here is what we intend to do as we power towards that recession. First of all, we believe that we're in stage 1, which is the rising inflation expectations period. And we have full market exposure right now. In investment manager speak, that means we have a beta of 1. A beta of 1 means if the market goes up 100%, you'd expect to be up 100%. If the market goes down 100%, you'd expect to be down 100%. We're carrying full market exposure right now because returns tend to be good during this period. When we get into the second stage, or contractionary central bank policy, that may be a time to take beta down. And so we could see a reduction in beta anywhere from 75 to 80% from 100. And then we get into pre-recession period, stage 3, at which point you're pretty convicted that a recession is coming, and that's the time to put on your maximum defenses. Once you're in recession, it's time to get long again. And that's when you want to take your beta up like we did in 2009 and enjoyed fantastic returns coming out of the recession. Now, for those of you who have been clients for a long time, you should be saying, David, that sounds like market timing. And you're right, it does sound like market timing, but I'm not endorsing market timing. What I am endorsing is risk budgeting. We have been at this for quite a while. I don't think the turn is imminent, but it's coming, and it pays to prepare. Specifically, because recessions only come about once every decade or so, the way that we're managing the economy. So the risk that we execute this strategy and miss is that perhaps we miss out on a little bit of upside. But after a decade worth of gains, my bet is that's a risk you'd be willing to have us take. So that may be the end game, but that is not today. In 2018, we still think this market holds promise, but we do think also you ought to mind your consumption. So our forecast for 2018 is that stocks will end the year higher than they are today. This market has definitely prioritized large companies over small, and even though I kind of like the dynamics in small companies better, at some point you just got to defer to the money flows, and so large companies could continue to hold advantage. In terms of style, I don't think that the love affair with the FANG stocks is going anywhere until we hit the next recession, and so growth probably continues to outperform value. In terms of domicile, late in cycles, you get resource constraint, which is usually good for commodity prices. Emerging markets make commodities, and so we think the emerging markets have a good opportunity here. In terms of U.S. interest rates, clearly at this point in the cycle, you'd expect them to go higher, and they're going higher. In terms of bonds, when interest rates go up, if you own interest rate sensitive bonds, that's a challenge. So if the economics continue to stay favorable, then credit should outperform. In terms of US dollar, path of least resistance is lower as long as there's still good risk appetite around the planet and people go in search of investment ideas everywhere. And then lastly, the primary threat is that we get a higher inflation number than we expect, which would cause the Fed to perhaps begin their pre-recessionary pattern earlier than expected and just accelerate the end of this cycle. But that is not the story, we don't believe. Overall, we think it'll be a good year, and so participate, but mind your consumption. So that was a lot, I understand it. But we put a lot of energy into this material because we understand the responsibility that you've put within our grasp. We know that your financial lives require rates of return. They require prudent financial planning. And the reason we know this is because we have our own families. We have our own aging parents. We have our own young children. We have legacies that we want to live through our estates. And so the advice that we're giving to you is the advice that we're also giving to ourselves. So truly, we are all in this together. I am tremendously honored by the confidence you have in Waddell & Associates and in our team, and grateful for your long-term loyalty. So that's a wrap for 2018, and I hope it plays out as we see it. Take care.